We would like to welcome you to today's last webinar presentation in our series. It's our National Fiduciary Liability Insurance Practices Year-End Insurance Review. I would like to introduce our speakers. We have Mark Dobro, Vice President, Matthew Jackson, also Vice President, and Brian Smith. He is our Senior Vice President and our practice leader. Now I'll turn the call over to Brian.
Thank you, Liza. Welcome, everyone. This is one of the webinars I think we very much enjoy doing, is looking at what happened during the year. The agenda is we want to look at how did 2012 do versus what we expected it would do. What were the big surprises we found? What are the important coverage issues that we're currently looking at and will continue to look at into 2013? What is the first cut of our benchmarking as to what it says went on during 2012, and then our projections for 2013, and then answer your questions. So looking at what we expected, looking at our four core products, starting with the fiduciary, which is the primary one that many of our trustees do look at as a must-buy, even though ERISA doesn't mandate it. I know I projected back at the end of 2011, we actually put out a Fiduciary Shield article, I think in October, saying we thought 2012 would be a hardening market. Matt, Mark, is that what happened?
Yes and no. For the larger limit accounts where capacity was an issue and there's fewer carriers available to compete, we did see some increases. In the 3 to 5% range, some of them higher, some of them lower. On the lower limit accounts, though, anywhere from 1 to 5 million, there were actually some new carriers introduced to the market, which helped bring down costs, which offset some of those higher increases on the larger limits. So we saw a little of everything in 2012.
It was kind of surprising. The entry of at least one new market maintained competition that we thought might start to disappear. All right, what about the fidelity bonds? We've been emphasizing fidelity bonds pretty heavily since the DOL came out with that field assistance bulletin in 2006. 2008. I apologize. So 2008 field assistance bulletin. We've been seeing an increase in activity in the fidelity bond arena. Mark?
Yeah, it's definitely the spotlight is on, and I would say, again, a lot more severity, and they're coming from all angles, too. There are a lot of different ways that the thefts are being perpetrated, and a lot of less traditional thefts are being perpetrated, too.
Define severity for me. What are you seeing out there?
Larger dollar amounts of claims. Larger.
10,000, 100,000, millions?
On a couple, we've seen definitely 6 figures.
Yeah, my memory is in looking at these, we've had a couple this past year alone that are hitting the high 6 figures.
That's correct, with multiple thefts being committed.
Yeah, many different ways of doing it. And then, of course, we have the one that's on the slide here, Madoff. And I know I spoke to the senior underwriter at Chubb about Madoff, and they were kind of, if we can say, happy because most of the policies that they had written where Madoff was involved were usually at the $500,000 limit, and they pretty much paid the limit in almost every one of them. And I think if I remember right, Chubb said they got away for something less than $20 million, which, considering the Madoff scenario, they thought was a very good outcome. That any natural person language in the Chubb form meant in every one of those bonds, I think it can say safely, in every one of those bonds, Chubb did pay. So that's been a form that did pay out in that particular arena.